Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings, everyone. Thank you so much for joining us. It is Macro to Micro Options Power Hour. I am Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht, our options mentor, educator extraordinaire. He's on. Ooh, you got some motion going on in your backdrop here. I'm same old. And just want to say thank you so much for joining us on this Thursday instead of Wednesday. We'll be back on the Wednesday schedule next week. But for now, we can wind up the week since we have a long Memorial Day weekend. Monday, the market is closed. A lot of folks will just exit stage left tomorrow, Friday, to enjoy whatever they got going on for the weekend, just a break. We have definitely had a lull in headline disruptions. That doesn't mean we have to be complacent. And right now the market is looking very excited about quantum and not about bonds. And so we've had some pretty strong sector rotations into some of the quantum computer plays that we've been chasing in the room, Google led. And then of course we've got bonds that are definitely saying, be careful about this House approved fiscal budget because they don't like it. So we did have a 20-year auction that did not do well. It had a big tail risk, which means basically the demand required higher yields. And then we had a little pop higher, but relatively speaking, US yields are at where they were, a little higher to start the year. More importantly, Japan is quite a bit higher. So I've got some eyes over there. We've got FOMC mid-March with Bank of Japan. I'm not expecting any Fed rate cuts. And yet we are still looking for some bullish impulses around that into end of year, and also some SLR relief for banks. And we'll see what else is going on. Stable coins right now, there's a bill that's expected to be passed. And although I'm not a big fan, it is absolutely backstop for treasury demand. So the problem is not that we have a lack of demand. That's part of it. It's that we just have too much of a supply because of increased fiscal spending. So that's what yields are telling us. That's what the bond market is basically warning us about. But the equities right now just don't care. So switching it over to you there, Hans, as you're rubbing your chin going, okay, what do I buy today? I know you've been doing awesome with your Bitcoin proxies. Bravo. That has really been very fruitful for you. Tell me what you think we got here under these conditions of weekend. Oh yeah. And Iran is threatening to bomb Israeli nuclear facilities this weekend. So we'll see how risk ends the week. We did make it through options expiration last Friday and VIX expiration on Wednesday. So it has been relatively a grind.
It has. The grind has continued apart from just the one day. And I think we were thinking as expiry ends, we're going to have a little bit more freedom to move about. And we just continued. Moody's came out and everyone said, well, this is one thing that could get people excited. And they went, who cares? We already know about these problems. And then I think we had some hot CPI numbers in Canada, UK. It's just generally a difficult backdrop, I think, for stocks. The bond issue is always going to be the big sort of elephant in the room, right? Because the market can handle some inflation, it can handle some sort of tariff imposed difficulties. But when it comes to bonds starting to move up in yields and potentially things starting to break again, then the market gets a little bit nervous. So it feels like there's this sort of that AI has brought us back a little bit. There have been some other sectors as well. And in some ways, it feels like I mentioned this a few months ago, and I said, I almost wonder if we're going to get into if you look at what AI is doing, and then God forbid quantum ever succeeds, I'm almost worried about that because then everything's really up in the air. But it's almost like we're entering into an era where there's disruption even to the great leaders. So you look at companies like Google. Now we've got this sort of existential threat to its sort of dominance that it's had over 25 years in search. And it certainly came out swinging with this $250 a month subscription. And I don't think it's so much that everyone can afford that. I think it's that people were excited that they're actually doing something, right? They're not just sitting there. And Google, I think over the last few years, people have gotten the impression that they're a little screwy. They were ahead of everyone in 2016, 2017, and then been sitting around as a few other companies have done very well. So I think it was a sign that, okay, Google does care. But I think it's also a sign that they're worried. I think they're legitimately worried that this is going to be very impactful. And so I think think while MAG has done well overall, I think we're almost getting into an era where it's not entirely clear who's really going to win in the end because of this sort of disruption, right? You have big companies with moats that are potentially going to be facing having to pivot and look at this new world of AI dominating. And so it's very interesting. It's the digital world that brings in a lot of questions. I think you can invest in it more confidently if you look at things like the picks and shovels. So Nvidia to me is a very solid place to be because it's not so much that they care who wins in the end, but just being the one that sells all the picks and shovels in the gold rush tends to be really beneficial position to be in.
But remember, they've got earnings next week. So there's a lot of risk facing Nvidia on the 28th. They have to
There is.
delight.
There's pressure for sure, but by everything we've been hearing, it'll be really a surprise if it's poor because everyone's been saying we're spending, and I truly believe there's going to be I think we're almost at an interesting pivot point again in AI, and I think it's going to be very impactful to the overall economy. So this is the stage where you could almost think of it as, okay, there's the training stage where it's, okay, let's just spend boatloads of money and train. Now we're going to get to the sort of inference side of the equation where that's what starts to get useful and is able to be monetized throughout the economy for those who get on board. And everyone's going to have to get on board. There's still this AI race going on. So the big guys have to spend tons of money. There's no question the gloves are off. You cannot hold back. And that's why Google's 75 billion and whatever, Amazon 75 billion. It is game on. We have to spend because it's quite literally almost an existential threat at this point to even a company as great as Google. And look at Apple took a hit. This Johnny Ive, he's teaming up with OpenAI. What's that going to mean to devices? So everyone's going, oh my gosh, these companies, these multi-trillion-dollar companies are now they're getting wake-up calls. And so there's almost, and I mentioned this 3 months ago because I just had this feeling that maybe people are going to pivot maybe to touchy-feely things, like real things. You talk about it sometimes, Samantha, this sort of digital into real stuff. And you can trust it. If I make coat hangers, that's not going to get disrupted so much. There's automation, there's all kinds of stuff, but it isn't so much just zeros and ones in the air that can suddenly completely change your business model very quickly. So I think there's this overhanging kind of worry that there's a lot being put on AI to bring this market back, but it's pushing against these very real sort of plumbing type things that you're talking about all the time, which is, are people still exiting US assets? Are they exiting the dollar? Are they exiting? There's some charts floating around showing there's a lot of money still leaving fixed income. So that's fraying of the edges of US exceptionalism. I think it's going to be a mistake because US exceptionalism is the greatest consumer in the world. It is the top innovations in the world. Yes, okay, everybody's got a shot to be good at AI and everyone's trying, but still the majority of the innovation probably still is to the US. So I think I'm not sure if those are bad bets or if it's just a rebalancing. So if you look at how much money's come into the US over the last 10, 15 years, it's been insane. So maybe it's just a necessary rebalancing and not so much we think US exceptionalism is over, because I think that is quite conclusion to make, and I wouldn't agree with it.
Well, I like the rebalancing concept because that's more positive than some of the risks that I'm still seeing. In all of your bullish sentiment, which is largely felt, there is still the worry. It's not, I'm with Ray Dalio and Stephen Cohen, and that the risks are not being priced in, especially as it relates to multiple compression, contraction. So the big tech right now has been this holdout of tech, of safety. It's defense in buying tech. I think that's going to go away. So I really do think that we're actually topping is this process, and very little is talked about China and their amazing advances. Now, we're not just talking about industrial and manufacturing here, but they did introduce DeepSeek on January 20th, became a thing. It was like, happy birthday, Mr. President, who on inauguration day. And that's still underestimated. China does not need, as much as the consensus again is still bashing them, does not need this dependence here on our ecosystem because they have created efficiencies because of sanctions to get around, and also to get around the sanctions. So I think there's still a big underestimation of China's role in AI dominance. And this is also stealing some market share, stealing some of the thunder away from this US exceptionalism, not to mention lower demands of dollar and petrodollar and oil. And they're all together. The trade for me is right now, we're in this kind of a great inflection point. I can see on a very short time frame, we gapped down, for example, on Monday morning. I even did a webinar 8:30, and then I had my live trading room right in the morning, pre-market, and said, I don't think this is going to continue, this 1.5% gap down. I can see that it's getting supported. But then Tuesday, Wednesday, I could see that there's selling starting in underneath the surface, and it has continued. So I'm actually bearish semis. I'm bearish into the end of the week. I'm bearish into Nvidia earnings. Now, maybe we price out some of this euphoria that has been built up from the May 12th gap up, which was on the heels of Trump coming in and basically saying Besant had really good talks with Geneva and de-escalated the tensions with China, and we're going to drop some of these tariffs down. But they're still on the path of moving into existence July 8th and August 10th, respectively. So we still have to deal with that. It's coming. In the meantime, we do have some treasury auction hiccups, and that is absolutely worthy of attention, not panic. Higher costs of debt and higher spending is going to put a stall in the equity advance at some point. The multiple compression is going to cause the big tech rotation, I think, to more value than growth, but we're not there yet. We don't have these hard data triggers of jobless claims and the rest to really get the market too excited. We're still monetizing debt. We're still with lots of money and lots of speculation. Bitcoin at all-time highs. The quantum computing sector rotation is very much exciting, but it's way off in the future. It reminds me a lot of the EV stuff that happened where this was exciting back in mid-2000s, and it ran up and then died an ugly death. On an ugly death, 2021 into the bottom right of the past few years where it has just not been able to get up off the ground. But in reality, the economy has transitioned fully over in China. The mandate for EV, 50% of ground transportation for this huge population to be EV. They're now the #1 seller globally of electric vehicles. So the point is, the hype usually comes first and then it crashes, and then the reality follows. I see that is a setup right now with quantum. It's still a fabulous chase. The speculation, oh my gosh, in the room, IONQ and QUBT and all these things that folks are holding for this wonderful, the explosion and advancement. But it's big picture, maybe not so sustainable for a few years. So we'll chase anything that moves. There's no question about it. But as it relates to a durable macro trend, it's not a safe bet that we're going to just blast off into 6,500 on quantum or AI alone. And I think Nvidia will show some cracks next week, Wednesday after hours, in profit margin, that kind of thing. How much are they selling to Malaysia to get to China? Maybe Trump will care. Anyway, we'll get to take a look at the report. But for right now, I'm not seeing any new sector rotation of size that's really going to steamroll the market higher. Long story short.
Yeah, and somebody mentioned the Gartner slope of enlightenment. Now, people feel like AI is newish in the last few years, but really, it's really got going in a big way in the middle part of the 2010s, and even back 2016, 2017, AI was able to do a better job than radiologists, for example. So there were already some pretty good advances, and so I think we're probably further along. I wouldn't say this is like a blockchain. Remember, blockchain came in and it was going to be a big thing, and so we're seeing the next stage of that in with all the cryptocurrencies and certainly stable coins and things like that. But AI is really it's useful to somebody sitting at home at their laptop as much as well as a corporation, entire industry. So it's going to permeate throughout industry. Now, I don't think it necessarily gives anybody a big advantage overall, because everyone's going to have it, and there will be some earlier adopters, but in general,
But it already has had its effect. We've got to find some fresh food here, because ISRG, AI, medical devices, that whole sector actually of healthcare, Stifel, right, very focused on this healthcare component. Alexander, we're so blessed, right? We've got Kenton's Corner of Biopharma in our Slack channel, Dr. Alexander, who is very focused on medical devices and the excitement that, of course, AI brings, like Tempest in early play, et cetera, et cetera. So we're able to find the beneficiaries, but there's also a lot of hits because of what's going on in DC to Medicare, Medicaid, and the healthcare providers, not just UNH on the fraud, but Humana and Cigna. So the navigating of all the medical device plays the past year or two or three has been outsized. Boston Scientific, et cetera, et cetera. But they're really extended. So they have been also a defensive kind of play in the hardware space of AI, and they have worked extremely well as trend longs because they've been very durable. Every dip has gotten bought in select names, but they're also extended. So I'm talking about finding kind of a new space. Quantum is still doing its speculation dance. Medical device within that has been beautiful. It has done nothing wrong. But as far as anything new, I'm not really seeing it. We actually have a pullback right now in gold. I think it's going to become a little bit more intense. So I'm looking for gold and miners to continue to soften since that April 22nd top call. So we don't have that rotation in gold. If anything, gold kind of succumbing to weakness is helping put a bid in equities. So I think that also rotation out of bonds into equities. We've got a few things that are going on. But for the most part, I haven't seen any really new, strong sector rotation. And of course, you can hide out in utilities and XLV, XLU, XLP, but it's not so exciting. So I'm more in tune to kind of looking to see what happens with banks and semis, both sectors look very tired. So they look like they're in a distributive top. And if we lose banks and we lose semis, why buy anything else?
Yeah, there've been a couple IPOs and everyone's okay, they're getting back on board with, hey, we're going to start getting some deal making and some that sort of revenue for the banks. I don't know how long that goes. There definitely is going to be, I think, a sort of slowdown that we've discussed that in the past. It all depends on how deep it is, how long it lasts. Is the market going to be able to look past that at a certain point? But definitely, I think AI is probably, it's the one. I agree with you. Quantum is one of those things where it's more of a trade than this point. But I think that overall AI space is you can buy high and sell higher. So I think then that's the power gen. I think there's quite a bit of evidence that ramps up the way I think it's going to, that really are going to have some power problems. So they're going to be infrastructure plays. They're going to be alternative energies. And
your mic, by the way, is coming in and out, by the way, just to let you know.
Oh.
Speaking of which, First Solar had a great explosion from the 400 week, and then it hit a descending 200 day. I said it was a good short. Anyway, his come back down. That's another example where I think it's going to be a few months, but it could base when you're talking about alternative. Also, Jeffrey is excited about the sodium battery. Anyway, that's very technical from an engineering mind, but I'm just looking at a chart setup. It needs a few months to base some more, but that is an area of potential. So it's stock picking. It's not really a sector rotation right now, long story short. But I will warn that right now the option flow is also I have my internal indicators that showed some weakness that we can tactically trade, and there's a really good reason to hedge. Lots of good reasons to hedge right now into July, August, and I want to focus on that because I did a write-up about that yesterday, in fact, and I know that there are questions around how best to hedge moving into this late summer, because usually it's dull. People don't trade or they don't actively trade because there's a lot of chop. That, A team, they say, goes to the beach and tells the B team, just keep it together. But we actually have some really big macro risk coming up. The debt ceiling has to get raised still. So this House bill, which got shoved through in the wee hours last night, only 2 Republicans voted no, even though there were a few more that said they wouldn't. Anyway, they cajoled and convinced them to pass it, and now it goes to the Senate. Whatever. The point is, we have to get we've got to get the bill finalized for the market to really have a sigh of relief. We've got the debt ceiling as part and parcel for that. We've got tariffs that are coming in. So Independence Day really should be renamed Isolation Day, but those are not likely to be pulled back. The dollar keeps falling, and the tariffs are still a major tool that Trump wants to use to quote unquote rebalance trade. And in the meantime, in the in-between time, companies are trying to figure out how to coast during Q2, which is not so bad, right? From an earnings standpoint, I've got data on that. We got GDP. We haven't shown any contraction of size to be worried about when you talk back the imports that have been surging because of trying to avoid tariffs. But we still have to deal with tariffs, Trump, taxes, debt ceiling. And in the midst of all of this, there has been no peace in Europe, not between the armistice that Trump was trying to force between Russia and Ukraine or with Israel. And in fact, Israel is doing its own thing without collaborating. So we definitely don't have a risk-free backdrop, especially when we have a failed 20-year auction like we did yesterday.
Well, yeah, and that it's terrible. It's an obscure auction, but point taken. And you've got Europe tossing austerity aside, so they're spending, and in certain places. And then you've got this sort of House bill. What is it? I thought the whole idea was to cut spending. Now Elon's off to do what he should be doing, which is running his companies. I don't know how much money they saved in the end, and now
Not
the
enough.
2020, the deficit's going up, right? So
not enough.
We're not really going in the right direction. And I think that's what yields are telling you, right? They're telling you that all is not well. And so this idea that we can just continuously kick the can down the road on debt and all these things is it feels like it's finally coming to a head a little bit, and people are voting with their feet and they're getting out of US assets and things like that. So definitely we've got problems. It's a very expensive market. So I agree with you, actually. Short term, I think we could probably get back down to sort of 55.50 as we sort out maybe this sort of exuberant bounce back into these levels that we've seen, 1,000-point rally minimum. And then I think that's where you start to get a little bit constructive and start to look to better times. Now, I know you have some targets lower than that.
Let's first things first, because we have to first sell. And right now we're not, just intraday. But I did want to go over this when you're talking about yields. Everyone's very focused on the US yield, of course. Curiously, we're really not very far off year to date. So I just wanted to kind of call that attention out, which is a good reference point. But the countries that are definitely feeling a much higher rate of change in their 10-year yield is Germany, and specifically Japan, United Kingdom as well. So there has to still be some attention on, and by the way, this is the result. This is a ratio, Germany to the dollar. Look at this parabolic move. Oh, this is on a monthly. Money has rotated in a big way as dollar has fallen and yields have risen, has rotated in a big way to other countries to chase that reward of higher yields. But what I wanted to show you was this big deal. Okay, which country is now the weakest? 10-year yields for the US are definitely an issue when it gets up to about 4.76, 4.8. But right now we're not there yet. So equities can still enjoy a little bit of slack. But UK and Japan, not really. That's harder for them to absorb. So the very long end of the bond market is definitely trading like a kind of a debt reckoning is coming. This was a client post that I sent out. Remember, Bank of Japan has their meeting mid-June, just like FOMC, and they're going to discuss all the things that are important, like yield curve control and more bond buying. So we have some ways to get through until this type of event. And that is another macro event risk, because they're going to try and keep that global carry trade alive. In other words, keeping yen down. That helps their economy. So we're going to have to keep that on the radar. It's threading the needle, if you will. The irony is Basent wants them to let the yen appreciate. And when it does, we've seen the damage that can befall, for example, the NASDAQ, when we had the yen carry trade unwind back in August of last year, and NASDAQ fell very quickly with semis and Nvidia. Anyway, long story short, that's still on the agenda of careful. Just careful as we get into mid-June. It's not straight up hockey stick for equities with these incoming macro risks. In the meantime, more hedging. Let's talk about that, because I did put some ideas here that I grabbed. UBS is out saying these are definitely strong candidates for outright put hedges. SPX skew supports put spreads. You've got JP Morgan actually saying they like August 25-29 call spread financed by a $16 put sold. You've got houses that are coming in here, JP Morgan. Goldman is saying despite all the positives that we see out there, through positioning, it has not rebounded. There are a few possible explanations, a preference among funds to look down market for alpha. Still, I'm struck by how unenthusiastic most investors seem right now. So we're not talking about the retail money that came in for 3 or 4 billion. We're talking about the hundreds of billions and why they're not buying up this market still. So there are some little caveats here and reasons why it makes sense. And then Nomura coming up and saying, S&P average stock IV has decreased, et cetera, et cetera. Long story short, it's cheap. And then my put call ratio that I shared as well, that is basically on a low that typically precedes, not a timing tool, but a few weeks, few months out, you get a very strong elevation in VIX again. I would say in that kind of late June timeframe to July, we'll see another resurgence of VIX. But for right now, these are all some of the reasons that are coming in for the market hedging. Thoughts on that?
Yeah, and I think that these guys do that all the time. They always give recommendations for hedges. And I agree. I was looking at something on the VIX today, selling some 17 puts to buy some, I think it was 24, 42 halves, right? And I've seen some other trades, some 1x2 trades floating about on Twitter, which I never like because they limit that upside. I don't like trades that can blow me up if things get really ugly. I think if you want, we've talked about it before, if you want hedges, you can just buy that convexity. It's hard to do something for nothing when you're really buying true protection. So I like those trades. I think you can do that upside call spread financed by some downside. Last week, we talked about how IWM might be an interesting place because those higher rates are going to be very difficult. I know you hate those small caps. So that's an interesting place where a continuation of the trends that we're seeing is just going to be increasingly worse for that part of the economy. So I like IWM to probably put spreads at this point. But yeah, I like some of those trades there you were showing and some downside, just basic downside put spreads. Only thing is I would limit at this point. I don't really like callers because I wonder if you could get that sort of sudden explosive move. So I like to the upsides. I like those plays that kind of give you the downside, but maintain the upside just in case. You've got protection nice and cheap where you want it again, generally speaking. And I agree. I think there are a lot of problems out there. I think they will be overcome over the next 6 or 7 months, I hope. And in the meantime, I think it's going to just remain a trader's market back and forth. And so I think you just keep monetizing, pick up some puts. Like I've been picking up leaps, but adding some hedges to them.
What about this chart? Does it give you any confidence in your put hedges or outright? In other words, this is Nomura, and you can see the outlier, right? I mean, it's wow. So not since COVID, second lowest since 2010. When you see these types of big moves in S&P stock IV, for example, does that embolden you one way or the other? Or is it just another data point?
Look, we came off fairly high levels, right? So naturally with all the flinches, we're gonna come down quite a bit as well. So I think on its own, it's interesting. It's always interesting to see, but we are seeing some things that we've never seen before in a way. We saw ranges that we haven't seen since the global financial crisis. So we are coming off some incredibly crazy volatility, which I noticed there was some metric in there you were showing that mentioned S&P vol versus realized, and it was the highest on record. Definitely, we've come off unusually incredible times, and so we're going to see some big crushes in volatility. I think you'd be irresponsible if you didn't add some protection here, just because we are always one tweet away or one Truth Social post away from something crazy moving markets again. I think that's absolutely prudent at this point.
This was the one I was looking for. So this one is the other. So this is put call ratio. It is not a timing tool, but you can see that when it gets way oversold a few weeks or maybe months later, we have some reason for hedging when you want to, not when you need to. That was a chart I was looking for.
Yeah, and really, we had everyone focusing on the puts and the skew was crazy, and then it's normalized. So now we're in a more normalized environment where you can pick up some downside for a more reasonable price, as well as the implied volatility coming down. So I think it's an interesting play. In fact, I've been playing some long options lately. Of course, in the usual suspects, I picked up some more MSTR. I actually picked up some IBIT because it's a bit like gold versus gold miners in a way. Not the same thing, but if you want exposure to Bitcoin, then go into Bitcoin, borrow, whatever. I know you think you're getting all this beta, but oftentimes you don't. If you want Bitcoin, just get into the IBIT. And so the option's been really cheap there. So what I'm doing is I'm setting myself up with delta long kinds of plays that give me a bailout. So I call it my Vega bailout. So I'm going to position myself long. If I'm right, I'm going to do well, especially in a product like Bitcoin, because if we start to get crazy movement, which we will at some point, if we start to get crazy movement again, then we will see an increase in implied volatility, even to the upside. And those upside calls will really catch a bid as well, because then people are going to feel like they're offside, or they want to grab that explosive potential. So that's always one of the interesting things about having way out of the money calls in this stuff when the skew is compressed, is that you get two benefits, which you wouldn't get necessarily in Microsoft, because as the stock goes up, usually they're just pushing down that upside skew. Those upside calls get compressed. So I always think this is an interesting place to be, especially given all the things that we're talking about. It all kind of points to a lot of uncertainty and a lot of crazy stuff happening below the hood, underneath the hood. And why not have some exposure there? You've got Bitcoin break. Gold's been I'm a little surprised it was down a little bit today, but
I'm surprised it's not down more.
not down more. Yeah.
I am. I'm still waiting for it to roll over. But in any case, right now the market is softening into Friday and probably right in front of Nvidia earnings, a little pensiveness. So I think we have to have that play out first. But yeah, I am bearish semis into the end of the week. Clients know that since Tuesday. Wednesday, we had a little shake and bake, but it's absolutely selling underneath the surface. So I'm comfortable with that ahead of Nvidia. But then after that, I have no idea. Besides, I already got my Nvidia, right? From 96 to 136, I was convinced. But after that, I'm like, I don't know. I don't care. Let's see what happens after earnings. Okay, so what are you playing right now? I know that you had a good thesis for Google. We're getting a question asked. How did you manage that Google trade? Because in many cases, trading isn't a game of perfect, right? This is like 50-60% chance. If you're right, you're still can make tons of money. But when you're not and you're using options, how do you navigate? Because Google announced this movie, some artificial intelligence movie making that looks so realistic, and the stock shot up and it has done really well. And quantum had already been building up since the past few weeks, and then it just took off with it. It's not the reason quantum plays took off, but the point is, how did you manage your Google?
Yeah, great. And now
question.
they're going to help with movie making too, so we could put another few 100,000 people out of work. Perfect. I like the direction we're going in, where computers do everything for us, and it's really wonderful because everyone's going to be able to buy all this stuff, and nobody's asking, well, where are they going to make money? Where are they going to make a living so that they can buy all this stuff? We'll have to cross that bridge when we get to it. Elon must have it figured out. Yeah, so we've got this position. I had the pair on. I had the long Nvidia, short Google pair, so it worked out. I used the upside calls in Nvidia, and then I had the downside puts, which are August positions in Google. So they're basically down to almost nothing. So I'm just going to hold on to those. There's no sense in selling them out for very little at this point. And I still think the thesis is correct. I think they hope this works out, this AI solution that they've come up with, hope that it works out. There's no guarantee that it will. Again, I think it's an example of them being worried and getting going on trying to figure it out. There's no question that they're moving their feet, which is good. You want to see that as a Google shareholder. That's absolutely true. In terms of that September, I don't know what we talked about. Is this a September downside put spread? Well, that's why I gave myself some time on it, just to kind of see how it works out. I wouldn't be too worried. I see some technical spots right here. We're bumping up on some highs from early March.
Okay, so you're going to hold on to it. The short duration pop is not a worry for you. I like this, that you have a thesis and you've got time with your thesis. So that answers your question, RP.
Exactly.
So everybody has to define their own time frame. That's why I put up a chart, honestly, in my trading room with hour, day, and week side by side, because some people trade a 1 minute, 15 minute, whatever. You do you. My point is that for me is just a chase. So we chased long Google to 173. It pulled back, then it went up to 176. But these are just day trades. So as far as now I understand, Hans, your thesis is you got this stuff out to September. You got plenty of time to move.
Yeah, I've got August, September. I actually have some puts out to a year from now, I think they are. So
glory. Okay. So that's a very conservative way. You're not worried about the bips and bytes. The bits right now that are being chased on the upside for the past few days, you're looking at a thesis of this thing's going to retest the lows potentially come fall.
Exactly. And if it doesn't, I will roll. I don't want to get into those last 2 months kind of thing. If I start to get a little bit too close to that expiry, I want to position myself to where I'm not getting that sort of decay curve pointing down a little bit more aggressively, right? So within 2 months, you're going to really start to see that time value come out of your options. So when you're playing the long options game, you really want to give yourself, I always look for kind of 4 months minimum in order for your thesis to play out. And I have this against all kinds of other longs as well. So it's not like the portfolio hasn't done well. So you can pick out trades that aren't performing at their peak right now, but it's one of several other trades that I have going for sure. But yeah, give yourself enough time. Absolutely give yourself enough time when you have these ideas.
So I want to just offer, this is Ask Us Anything. So you're asking about the Google structure, which is obviously into September, and you've got Oklo, okay? Like I do this all the time when I'm looking at individual plus options, but as it relates to Oklo, it looks fabulous.
$3 billion worth of at the money leap calls that somebody's been amassing, Samantha.
In what?
$3 billion worth of calls, like massive. No, Murray was talking about it, just huge.
Of what?
Of
Which
just
issue?
a swath of the Googles, the Microsofts, the Netflixes, Nvidia, all kinds of things. Snow, so definitely a lot of AI plays in there. A few other things, UNH as well. I'm not sure where they started on that one. It's probably not.
Because UNH had capitulation selling on Thursday. That was a fabulous. So one of the things, even though it's a complete dangerous issue, here, can I show you something? It's cool. At least in my little world, we caught this live, so it was very intense, just put it this way. All right, so I'm going to just show you something real quick. UNH, and they can do whatever they want with it because I have no. All right, so in this UNH, I want you to focus on the weekly because you just brought it up. It's a really good point. All right, so I had 260. Anyway, people wanted to know as this kept falling and it was too ginormous. In other words, the expansion bars were way too scary and there was no buying. This is a weekly chart. This is a daily chart. There was just absolutely a debacle of a gap down and there was no buying and everyone's, can we get it? Can we get it? Can we get it? And I'm like, no, this is a trend and it's breaking everything. These are monthly levels that I had on for clients. Anyway, long story short, I had said, I've not seen a major issue like this. This is the number one leader in the healthcare space, but I've never seen a big stock like this get sold so aggressively outside of a fraud case. And then last Thursday, which happened to be this bar, it came out that it was being investigated for fraud. Now, the reason why I'm pointing this out is because I said, I think that's it. Because that was my level that I had, that it was going to tag at some point if it broke the 400 week. Anyway, long story short, let me just show you what happened when capitulation selling comes in. See this ginormous candle right here? And then another ginormous candle? They swamped anything you can see in UNH's history. This is a daily candle of just plain old volume. But this candle swamped even these. And that's when price stopped moving lower. So I was in my trading room live and I said, if it can get back above, it hit a low, but I said, if it can get back above 256, it's going to push back higher. It ran 20% from that level because it was done. The sellers had already, the bloodletting was already done. The sellers had already finished before the news came out. It was capitulation selling. When the volume swamps anything you've ever seen before and the price stops going down. Anyway, it's just a little rule that I've learned in stalking stocks. Avoid, wait for capitulation selling, then go in if you want to scalp it, sell those puts. It literally moved 20% perfectly and now it's done.
Yeah.
So that was just a trade. But you're saying they're coming in and now they're positioning because unless it's going out of business, 50% for this type of issue, which is all the way back to 2018, is a fire sale. And yet it had a lot of problems. So it's
well, that's it. And
yeah,
they're probably not being investigated for fun. So that something's going on. And I had a member who was short. They sold a put credit spread vertical right before all this happened. It was just terrible timing. And so one of the things that I teach is how to play those verticals that go against you and how you can play with the long piece. We've talked about that before, with that long put to try to monetize and reduce the damage in that position. And I said, he wanted to take it off around 325 or something. And I said, you want to wait when you see a move like this, basically what you're saying, Samantha. I said, you want to wait for something to find a bottom, because when it's in the midst of just a complete free fall, you're just flipping a coin, right? You're trying to catch a falling knife that is just speeding down towards the center of the earth and you don't know where it is. So I said, listen, you want something like this to find a level, then you can get involved. And so it found that level that morning. I said, it's looking interesting here. And what I like about it is it's had the bounce, the requisite bounce, and then now it's pulling back again. So I think it looks interesting under 300 here. And confirming that is the fact that implied volatility was basically straight up, looked like a massive tree just reaching for the heavens, one of those trees on the west, massive trees. And so now it's come down, right? The implied vol has come out of it. So it's saying, listen, we've found a level. I don't know if 250 is the level, but we've taken out that sort of, we have absolutely no clue where this thing's going to stop. We've taken that out out of it. So now it's an interesting time. You can get involved and start playing the ranges, but I like to wait till you find that range. So now I could go in there and say, listen, I'm not getting that crazy, ridiculous vol on my option pricing, but that's okay because I didn't know where the bottom was going to be. Who knows where it could go? Now you can start picking a level and saying, okay, this is a little bit more stable. It's not my favorite thing to get involved in from an income trade standpoint, because for income trades, you want stability when you're doing credit spreads, and most certainly with cash secured puts and things like that. You want stability, right? You're selling leverage in a way. So you want some kind of stability on top of good fundamentals. The fundamentals part, we don't really know. You have to get involved. Now that we've set price, you can get a little bit more involved. So to your point, yeah, you want to wait. You don't want to get in the way.
Your mic keeps just so you know, strangely keeps cutting out. All right,
Yeah, I
so
don't know.
what do you have then for other VIX type of protection? I know you talked about what do you have that's short and or hedges?
Short.
Otherwise, I know you're long with the Bitcoin proxies. I know you have your Uber and some other core holdings that you work around that are still bullish. But what do you have that's bearish?
Bearish, bearish, bearish. Well, I've been picking up some downside spreads in the Qs because we've just had this sort of exuberant run up here. Again, as I was saying earlier, I'm not sure if it's going to be everybody wins at this point. I think there are going to be pockets of maybe not Apple, maybe not Google for a bit, although I've been wrong on that one so far.
Only a week.
It'll be a little bit more bifurcated as opposed to everybody wins all the time. So I think that's good. I like Hood. I think Hood still looks good. In terms of playing that downside, I think like in terms of individual ideas, I don't see a lot there that's getting me too excited. But in terms of those overall hedges, I think it could go into downside QQQ, put spreads, something like that might be good to monetize if we do get a pullback in the S&P of maybe 300 points. The Qs will probably get something similar. Yeah, coin. Somebody's asking about coin. I was long coin and I sold that position literally before they were announced that they were being included in the
S&P
S&P.
inclusion, yeah.
That was really a pretty special timing there because I held on to it for a couple of weeks, but that's how it goes sometimes. It was ahead of earnings. That's right. I sold it ahead of the earnings because I said, you know what? I don't want to hold it through earnings. And then the S&P inclusion came in. So playing the coin, playing the MSTR as well. But that downside, I think in the Qs. So what I would do is I'd look at I'd give myself a little bit of time. If you were a little bit more short-term oriented, you could position yourself in maybe like a 2-week option. You're going to get a little bit more reactivity out of it, a little bit more of that gamma, as I sometimes talk about. So you could maybe do even a regular June, something like that. And where we're trading 514, you could maybe pick up, I like to set that first strike maybe around the 35 delta. You could pick up maybe a 35 delta 504 put. And then the skew ends up being, if you're not super, super bearish, but you think we're going to come down a little bit, you can do a 1x2 or turn it into a put fly. So to the downside where you're targeting maybe a 5% sell-off and set the middle of your butterfly for right around that 5% sell-off, or maybe just a little bit lower because we often overshoot what we think is going to happen. And then you'll have this sort of extra protective put way at the bottom put of your fly. Whereas 1x2s, you can get maybe in a little bit of trouble if something terrible happens, somebody attacks somebody, and we just get one of those big gaps down that can be very painful. I remember last summer there was somebody pushing some service where they were doing all these 1x1x3s, like these crazy put ratios where it was like, oh, this is great. You just sell these way out of the money puts to finance those front put spreads. And it looks really good on paper because you don't think the market's going to really get crushed. And then of course the unthinkable happens. And the problem is those kinds of strategies are really pro strategies because pros are a little bit more able to, they've got their finger on the button, right? So when retail does stuff like that, they're like, they get home from work and they're like, what just happened there? So I'm always very critical of people pushing these risky strategies out to retail because it's difficult. Even for a pro, it's hard when something's really raging against you. You can't help it. Emotion gets involved. So you want to keep yourself protected, generally speaking. So put spreads, butterflies, things like that to the downside. Now, to the downside, you don't necessarily get that nice exposure to a compression of implied volatility, which is those option prices coming down a little bit because to the downside, they expand. So the butterflies act a little better to the upside. It's definitely one way to play the downside if you're not super, super convicted. If you really feel like we're going to come off, then a put spread's going to make a little bit more sense.
And someone asked about the E-mini chart that I show once in a while. Really showed a nice positive breakout higher in liquidity on April 23rd, just when VIX started to really soften April 22nd, and then right down into options expiration yesterday. But this is up here, this 59.28, which tagged last Tuesday. We've been hugging it, snaking around it, nothing convincing. So one whole week, we've really not gone anywhere fast. If we get moving, we'll go tag that 61.27 up here. If we fail, we're going to go back and fill this gap, which is about 56.87. So we're equidistant between them. We really have to have a push. Now, I happen to be short-term bearish into this week and into the beginning of Nvidia. So I think short semis, short Qs, all that stuff is going to work in the short term. But ultimately, we haven't rolled over. If I'm just looking at Nvidia, I loved this rounding top here on the intraday, and then it did a beautiful bull trap before it dumped, and it still hasn't really rejected that 136. So I had that 136 forever, right, on the run up, and now it has just been there for 7 days. It hasn't done anything special. You got to add some time for this because it's obviously a theta decay killer. But otherwise, that's really, I'm watching very interesting yields, which nobody else cares about mostly. But are we going to have this resumption higher, which will become an equity headwind? Or are we actually going to get some bond relief because of policy intervention? SLR is relaxation for capital requirements at banks, although banks don't look good right now. Also, the House bill passed. Now it goes to the Senate. It will be changed. There'll be wrangling and all of that drama that we have to look forward to. I'm not really seeing anything other than that stablecoin Genius Act, which is an oxymoron. But the point is, it will create demand for treasuries, which is supposed to backstop the falling bond market. But in reality, that's not the issue. They can contrive and bond stuff to their heart's delight. It's still not going to solve the issue of increasing supply. So they can force people, countries, banks, whatever, to buy, but they really have to get control of the need for the supply. And that's what's not under control. So we still have that to deal with. In the meantime, markets just underneath, it's starting to show some signs of fatigue and selling, but that typically means it's a few weeks out before we get an air pocket of risk that gets poked. And in the interim, they could come out with some lever to help excite the bulls. And there still is this underperformance, and definitely it's notable that we haven't broken out, but we're so close. So we have to keep that in mind, especially when we see stuff like Google taking off and quantum taking off. There are still pockets of money and Bitcoin taking off. You still have speculation in the market. So liquidity has not left. Enough liquidity has not left, even with a soft dollar and rising yields, to interrupt these bullish flows. Big picture. Short term, I see weakness in the Qs and with semis into Nvidia. But after that, I think we're going to have to see how the market reacts to Nvidia. So
yeah, we saw that. Even I'm looking at even some of the longer term option pricing on Nvidia. They've crushed it. See, I'm seeing this in quite a few names. It's not just Nvidia. And they're starting to pop up a little bit, like they overdid it. So the market overshot to the downside on the pricing, and maybe we're finding a happy place. So the VIX probably, I was saying maybe we get down to that 16, 15 range, but that might be a little low at this point, given what's going on, especially with these auctions, especially with what yields are doing. That is really the elephant in the room. Like I said, it's the market can handle a lot of things. I think you want to watch for yields, right? Like I think under 450 on the 10-year, I think stocks probably start to get a little bit happy again. But if we push a little higher, it's going to make things very. What about are there any places to hide, Samantha? We know utilities? I think
no, they're not. They're not exciting, but they're definitely safety. Right now, folks are hiding out in medical devices. That's really obvious. And of course, quantum chase, and of course, Bitcoin. Looking for a bond support that still makes me very bearish big picture into Q3. Nothing has changed. Q2 is just the stagflation, the recession risk, the growth scare were pushed out. We've had our nice V-shaped recovery. We could still get some bullish bent, but we would need some more growth factors to do that. And I just don't see that into July. I see it for June. I think we can get supported in June, but I don't see that towards the end, post FOMC, post BOJ, into July tariffs, which then feed into August tariffs. So I actually think we've made hay while the sun shines, and it's summer and people are going to go to the beach and volumes are going to get thinner. But barring some type of weekend risk like Israel's threat of striking nuclear facilities in Iran, we don't really have a macro trigger for for VIX until July. So I'm sticking with that.
Hurry up
Yes,
and
and
wait is what
nuclear.
you're saying. Hurry up and wait. And
Hurry up and wait. Yes.
hurry up and wait.
Yeah.
That's what, and William says nuclear as well. Yeah, I like to see, I own Cameco, so it's nice to see those come back. I really think that's an interesting place as well. I think the whole AI theme is, I think we're going to run into some power problems at some point. It's already being seen in certain cities where they're sucking, these cities that have these data centers nearby are starting to get these sort of disruptions. And I think that continues to happen. So I think that's an interesting place to be. You're either generating power or you're involved in infrastructure somehow, fixing things, upgrading things. It's old, a lot of it's very old. So I think that's an interesting place where
there are some infrastructure plays for sure, but right now we have to see where this bill's going to land with the Senate. A lot is tied to the Biden spending of last year. What's going to be, like you saw what happened to solar today. Once they passed the bill in the House, there was just a bloodletting. Luckily, we were short first solar, so that really helped. But I think in time, once it gets resolved, that can actually be supportive for a move higher, but that's later. For right now, be careful on gold. I still see it shaky, although trend long, you're fine. But in the short term, I still see this continuous contract heading back down to maybe 3,000. So I had 3,250. I think it could actually go a little bit lower. And if that does happen, typically there is a rotation into stocks. So it's a little bit early, but I've been on this since April 22nd, and I keep revisiting it every Wednesday. We keep making higher, lower highs. So the next one might be a little bit lower.
You don't have your tin hat. Gold's going to 4,000 anytime soon.
Oh no, I totally think gold is going to 4,000, just not in the next few weeks. No, I think we definitely, anything that happens with gold on the downside will get bought. I'm still very bullish gold, but I'm saying right now with this Bitcoin rotation and the stock rotation, money is rotating out of gold, GLD, and that will put some pressure on, I believe anyway, that sector. Remember, it was flying and doing phenomenally well. So it's not a surprise for it to take a breather. I think it's just fine. Miners are definitely crushing earnings for the most part, and now there's M&A in that space. So there are some really good plays still in miners. Again, trend, swing time frame. Just be careful of the underlying. That's all I wanted to say.
Hate the miners, William. I ran a miner fund for about 10 years, and it was amazing how often you'd say, man, this miner's going to knock it out of the park, and they screwed it up again. They're just, these guys, I don't know where they find them, but having said that, they have acted well, finally. But typically, finally.
Sorry for your long suffering.
It took 3,000 gold for them to not screw it up, finally, which is, I'm impressed.
Let's look forward to 4,000. All right, everyone, have a great rest of your trading week, a wonderful long weekend. Market is closed on Monday, but we'll be back on Wednesday. Thanks again, everyone. Cheers. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.